Yeah, so if you look at Greece, they're the first developed country to be demoted to an emerging market, and that's been a totally different investor base for the country. If you take look at this chart, hopefully it comes up, there we go. You can see where it happened at the end of 2013. Basically, all the developed market investors, they got out, the emerging market investors got in. The data comes from eVestment. It shows $1.7 billion in reported equity exposure to Greece, with another $250 million in fixed income. Of course, after switching to emerging market, major investors sold emerging market players. They are the ones who came into the game here. So even with that massive shift, you saw the fixed income is where the volatility it's been. The equity has actually been pretty consistent. So if you actually look
what happened to 2014?
Well, this is based on the beginning of the year. If you look at the number of funds that are invested, you look at these institutional funds, right? Not governments, they have a mandate. So if they're supposed to be in developed markets, they have to be in developed markets. When Greece got taken out, they couldn't invest anymore. That left the door open for these emerging market players. So the investors that we see right now, they are not the same investors from before. This is an example of that. These are the active developed market buyers. These are the active emerging market buyers. There was just a big gap. They all got out. These guys all got in. So the point is that if you're looking at this trade over the last 5 years, it's not even the same people who've been involved in that trade. It's a totally different investor class. That's what makes it really interesting. These are the guys that knew what the risks were when they came in, just the more advanced funds.
All right, Eric, thank you very much.
Eric
Chemi has more on this story, and to find it, you can go to powerlunch.cnbc.com.